Andy, I think you're going to make me sad because you're about to tell me about some pre-budget speculation that could affect GP partners.
Yeah, so the caveat to this is pre-budget speculation. Let's not get carried away. This isn't fact, but it's something that's been talked about before, and it's to do with national insurance. So please don't all switch off. It's a fairly dry topic, national insurance, but actually it's quite an important one. There has been a report issued in September by something called the Centre for the Analysis of Taxation. Now, what a great place that must be to work. It's called the Equalising National Insurance on Partnership Income, Revenue and Distributional Effects. So, I think this kind of sums up. It's quite a dry report. But basically what it identifies, and this is a well-known issue, is there is a difference in national insurance that's paid by people who are self-employed and people who are employed. The main difference by far is that people who are self-employed, there is no employer national insurance paid on their behalf. Whereas if you're in an employment role, your employer will pay employers' national insurance, which, as we know, went up in last budget to 15%. So there is a concern that there's a bit of a tax gap arising, and this report focuses purely on partnerships, which are only one subsection of the self-employed workforce. The reason why it focuses on partnerships is its view is that partnerships operate very similar to companies in a corporate model, and therefore having different tax regimes seems a bit odd. But more importantly, it identifies that partnerships are used by higher earners. So the four biggest categories it identifies are solicitors, which they say partnership income is 7.2 billion, financial services 6.7 billion, and then third on the list, GP partnerships 3.6 billion, and fourth on the list, accountants 3.3 billion. So Ed really being both an accountant and a GP, albeit he's an employed GP, so not really affected, but anyone who's like Ed really could be at risk here. The current position is employers pay a 15% employers' national insurance rate on any income that an employee earns above 5,000 in a year. But equally, that applies to both companies and partnerships, because if a partnership employs someone, they have to pay that employer's national insurance. So this is just really focusing on the partners themselves. What they have proposed in the report is pretty similar to, at the moment, most employers get an employment allowance to sort of mop up the first bit of national insurance that needs to be paid. And to protect small partnerships, they propose a partnership allowance. Interestingly, though, when the budget came out, the Treasury didn't actually understand that GPs didn't actually get access to that employment allowance because the public sector don't. So they would need to change that rule. But they would get an allowance, but then actually they would then effectively charge an extra rate of national insurance on all partners. It won't be 15% because of just the methodology of tax relief and how that works. It was something less than 15%, but it'd still be quite significant. I think it was something like close to 7% they were proposing as an additional new rate of national insurance that partners would pay over and above £5,000 of income. If that came into play, that would be significant. The estimate within the report is 96% of GPs who are partners would be impacted, and it would raise £250 million of extra national insurance from GPs alone. It does also point out that the government may choose to recycle that back into the contract if it went down this route, but obviously that's just pure speculation. Why are they considering this? Well, there is a difference. There is a difference, but sometimes there's a difference for good reason. Employment has a lot more protection than self-employment. Partnerships who are self-employed, don't necessarily get regular income, don't necessarily get the benefits of being employed. But there are issues with this. It doesn't deal with self-employed sole traders. So it's weirdly enough just saying partnerships rather than sole traders. So you could have a sole trader GP who wouldn't be impacted, but a partner GP would be impacted. So that doesn't seem particularly logical. But it could be an easy target for them to go down because, it's very clear that partnerships are used disproportionately by higher earners. And equally, they did the geographical analysis, its distribution is actually to more affluent areas as well of the country. So politically, it would tick boxes from that kind of wealth taxing perspective. As I said, it's always budget speculation. I think at the moment, though, this government are really looking down the back of the sofa again to try and find some money. So it's not going to move away from its principles that it set out in its manifesto. And this wouldn't be a move away from that. So it is a possibility. I kind of feel that there might be something on this. I'm not sure it would go to the extreme of this report, but it certainly could be something that gets targeted.
While I take a breath to compose my thoughts, and Ed, got any intel?
Yeah, I mean, I think as Andy says, I think they are very. It does seem this report is very much thinking that a lot of the partners and partnerships are for sort of wealthier classes like solicitors, accountants, and so on. I think they put in their report that, I think they mentioned that the top 0.1% of UK taxpayers are getting 46% of partnership income. So I think there's a chance that this might become more than speculation, just because it may be seen as a target on wealthier people. But as you say, there is the whole point of, in my mind anyway, there are different national insurance regimes for self-employed for partners compared to employment, because as Andy said, there's a difference between employment and self-employment in terms of the risks that people who are self-employed take. And my understanding was that national insurance was one way to, incentivize, I guess, people to be self-employed or partners, or rather to compensate them for that risk that they're going to be taking compared to being employed. Just one thing, just kind of linking back to something I talked about at the start, about the marginal tax rate. So I'm just trying to stop my cat from walking on my keyboard. She's just appeared. Yeah, so we talked about marginal tax rates. I mean, this, from what their report says, would increase the marginal rate for an additional higher rate taxpayer by nearly 7%. So the marginal rates for additional higher rate taxpayers who are partners would go up by 7% if they did bring in this taxation of employment. Sorry, just moving my cat out of the way. So again, that would change incentives. We talked about the start about tax rates driving policy behaviours or people's behaviours, and this, I think, would be another can of worms potentially.
I think,
and we said that we.
Sorry, well, the one thing that was, the report has a few gaps in it, and the one thing it didn't really tackle is the fact that it kind of assumed that anyone that was operating through a company was taking all their income out as employment income and therefore paying national insurance on all their income. Well, that's not the case. If you're a business owner running a company, you will take your income out as a mixture of employment income, a mixture maybe of pension contributions, a mixture then of dividends, and dividends aren't subject to national insurance, albeit dividends have different tax rates. So if this kind of came in, they would need to ensure that there is an alignment in the dividend tax regime with how you potentially tax stroke national insurance partnership incomes. It's, as I said, it's an interesting report and clearly something being debated, but I think in terms of the nitty-gritty, a lot would need to be done to make sure there is clarity and fairness across the board.
Yeah, I mean, we said we weren't going to speculate on the budget, but I guess if we see something, and of course, no one knows, right? So this isn't a prediction, but some things you could see why they might be tempted to do it. And so they've already said manifesto commitment not to raise income tax, I believe. The fact that they've frozen the allowances and therefore increasing the amounts of tax everyone pays massively by fiscal drag. Don't worry, the general public won't understand that, so they can carry on with that manifesto commitment. But this just aligns with their kind of theme, which is sort of aligning the differential taxes the way that capital gains is an example. Capital gains is coming closer to being taxed like income. So it's like a theme that they want to align taxes more like income. Capital gains tax increased. So I don't know, but you could see a world in which this makes sense. But can I put Andy on the spot and ask him a question? Because you said it affects partnership income, and GP partners are a little bit unique in the sense that because of contracts, etc., it's very, very difficult for a GP partnership to operate as anything other than a GP partnership. I would love to operate as a limited company in my partnership, but various reasons, which we've covered at length on previous episodes, it's not that easy. So GP partners would have a hard time avoiding this, is my understanding. But if for accountants and stuff, would they not just change their business structure and become a limited company and just avoid it that way? Or like how is this not going to be super easy to avoid for anyone who is not a GP partner?
So I'll just correct you. GP contracts can be held by limited companies. It's difficult getting it into it, and actually at the moment, the reason why mainly it isn't is actually partnerships have benefits, and not just simply tax benefits. Have benefits in terms of flexibility in how they're run, which is why it suits professional, organisations. This is why solicitors, accountants, GPs, financial services are all on this list, because actually the partnership model as a corporate model works actually very well commercially for them in terms of how they operate. Yeah, you're right. With anything like this that comes in, if there is an alternative that people can shift to, they're going to do it. Which is why my point is, if this does come in, everything is going to have to be aligned. They're going to have to change dividend taxation. They're going to have to, make sure that both models, operate in a very similar way, because otherwise all you will do is get people trying to avoid it by shifting the corporate structure.
Yeah, I should have done a ad read there, because if you want to know more about different structures that partnerships can operate under, such as a limited company, then you need to come to Medics Money Live in London, which is on the 7th of November. I've forgotten the URL though. I think it might be medicsmoney.co.uk/events for more information. So a load of GP partners, all the best experts in the game in real life, which the kids put IRL. That's like, so yeah, I'm pretty cool because I know what IRL means. In real life, in London. Check it out, medicsmoney.co.uk/events. Okay, watch this space. Yeah, I'm going to ignore that speculation, but yeah, hopefully it's incorrect. All right. I thought we could, something's coming out of my printer, which is unexpected.
I think it might be Ed's cat